Imagine this for a moment. Two people, same age, same city, same job, same salary. Every month, both receive their income. The first person spends most of it on rent, food, transport, and small enjoyment, and whatever is left sits quietly in a savings account. The second person does something slightly different, nothing extreme, nothing risky, just intentional. A small portion of their income is invested calmly, consistently, without drama. 10 years pass, same effort, same income history, but very different outcomes. One feels financial pressure every month, the other has options. What caused the difference wasn't luck, secret information, or intelligence. It was investing. Investing is one of those words that intimidates many people. It sounds complex, risky, and technical, but at its core, investing is simple. Investing means putting your money into things that can grow in value or generate income over time. You are not gambling, you are not guessing, you are not chasing quick money. You are giving your money a job. Instead of money sitting idle and slowly losing value, it begins working for you. And that simple shift quietly changes everything. Many beginners confuse saving with investing. They sound similar, but they serve very different purposes. Saving is protection. It prepares you for emergencies and unexpected expenses. Investing is growth. It prepares you for the future and long-term goals. Saving protects money from sudden problems, but investing protects money from slow problems, especially inflation. Because the truth is, money that does not grow is quietly shrinking. Prices rise, costs increase, and over time, cash loses purchasing power. That is one of the main reasons investing exists in the first place. When people talk about investing, they are really talking about assets, things people put their money into so it can grow. Some people invest in stocks, which means owning small pieces of companies and growing alongside businesses over time. Others invest in ETFs and mutual funds, which bundle many companies together, making investing more diversified and beginner-friendly. Some people invest in bonds or treasury bills, where they lend money and earn interest in return, usually with lower risk. Many people also invest in real estate, buying property, land, or rental homes, earning income and benefiting from long-term value growth. Others invest in commodities like gold, which people often use to protect value during uncertain times. More recently, some invest in digital assets like cryptocurrencies, which are highly volatile and risky, but attract attention because of their potential returns. The key point is this: all investments are different. They carry different levels of risk, return, and time commitment. The goal is not to invest in everything. The goal is to understand what matches your goals, your timeline, and your comfort level. One of the biggest myths about investing is that you need a lot of money to start. You don't. What matters far more than the amount you invest is time. Time is the most powerful ingredient in investing. When you invest early, your money has the opportunity to grow on top of previous growth, a process known as compound growth. At first, the progress feels slow, almost boring, but over years, that growth builds momentum. Someone who invests small amounts early and consistently often ends up ahead of someone who waits for the perfect moment and invests a large amount later. Time does the heavy lifting, not luck, not intelligence, not effort. Risk itself is also misunderstood. Risk does not mean danger. Risk means uncertainty. Markets rise and fall. Prices change. That is normal. The real risk is investing in things you do not understand or staying out of investing completely because of fear. Over long periods, disciplined investing actually reduces risk. Emotional decisions increase it. Another reason many people delay investing is the belief that investing is only for the rich. but investing rewards consistency more than size. Small amounts invested regularly can outperform large amounts invested once and forgotten. Discipline beats speed every single time. Most beginners make mistakes not because they're careless, but because they rush. They chase trends, they follow hype, they panic when prices fall, they buy when everyone is excited and sell when everyone is afraid. But excitement is not a strategy. Boring investing works, quiet investing works, patient investing works. Successful investing is more psychological than mathematical. It requires patience, consistency, and emotional control. You don't need to watch prices every day. You don't need to react to every news headline. Wealth is often built quietly, without noise. When you hear urgency, pressure, or guaranteed profits, that is usually a warning sign. The best way to start investing is simple. Learn the basics, start small, choose beginner-friendly investment options, increase gradually as your understanding and confidence grow. You don't need to be perfect, you just need direction. You can't predict the market, you can't control the economy, but you can control your habits. And investing, done simply, patiently, and intentionally, is one of the most powerful habits you can build over a lifetime. Stay curious, stay smart, and don't forget to like, share, and subscribe to Smart by Cashie.